literally 1.6 million in revenue when I got it. And now this year we'll do 150. Overhead is the poison of your business. And making profit in your company is not natural. I've met people that are 30 million in revenue and still are using the cash method and don't even know what the accrual method is. And that's a great way to destroy your business. Save your marketing. It's kind of like storing bullets in your gun. Our call booking rate's really high, at over 80% with the virtual agents, and our bounce rate is 40%.
Welcome back to the 8-Figure HVAC Brands, the podcast where we bring you the real stories behind the companies scaling the industry. I'm your host, Daniel Dramshev from Network HVAC, and today my guest is Tom Howard, who started the sweeping floors in the trades at 15, and he bought his first HVAC company in his late 20s with literally no capital, no money. And today he runs 8+ companies. He's VP at ServiceTitan. His book, Fetching Millions, came out last year, and his biggest company, Lease Air, is on track to hit 140 million in revenue this year, with a target to be sold for what could be close to $500 million. Welcome. Really glad to have you here.
Yeah.
Is that all correct, what I just said about you?
Yeah, we just did an acquisition recently though. So it looks like with the acquisition, we'll do about 150 million, but it was accurate when I gave you the information. The sale price of the business isn't going to be $500 million. I mean, I wish, but it'll be in the hundreds of millions. So we're pretty happy with it.
Yeah, that's awesome. And you plan it for the end of the year or next year? What's
the plan?
We're
going to market in about a month. So if you're listening to this, it's we're going to market in July 2026, and so it'll be later this year that it'll actually close.
Do you know already who's going to be the buyer, or there are several options for you?
Oh no, there's several options. So there's people already expressing interest over the past 2 years. I've been getting a phone call probably at least once a week. I know a lot of the listeners probably get phone calls from various private equity companies. We're going through a banker. The banker we're using is Houlihan. I've used other bankers before, including Wayne from League Park. I really like him. I've dealt a lot with Eric from Piper Sandler, formerly of Cowen. He's awesome as well. We interviewed a lot of bankers. Blair, I really like them. And anyway, we ended up with Houlihan, and things are looking good so far. And then we went through our quad of earnings already and all that stuff. So we're really just getting ready to put it on the market.
Cool. You know, like people, they know you as you buy, scale, and sell HVAC companies and home service businesses in the market. But let's start from the very beginning, or from your beginning. For those who don't know you yet, or who didn't hear your stories, how did you get started in HVAC, and how did you acquire the first company?
I got started in HVAC. I was literally cleaning trucks and sweeping floors for a HVAC shop that was about 3 miles away from my house. I used to ride my bicycle to their shop and then start work after school. The guy it was his house, and then behind his house was a shop, and that was where his HVAC company was. I think it had a total of like 5 employees, super small. Anyway, I learned things there. I went to HVAC tech school while I was in high school, mostly because my boss said he'd give me $1 an hour raise if I took a class. So I did, and I just kept growing from there. I thought I was going to do it just to get through college. I was going to go to school for finance, and I got to school and realized I didn't like finance. Well, after I graduated, I didn't like finance. And so I ended up coming back. Got offered a job as a general manager at an air conditioning company that I used to work for before, a totally different one. The owner had a death in the family, and he wanted to get out. So he offered to sell it to me, and I didn't have any money to buy it. And it wasn't worth as much as he wanted, but he said, look, if you pay me what I want, then I'll carry the note, which means you just make payments to me. And I said, okay. So I took that deal, been making payments for a while, and then eventually just got a bank loan to buy them out. And that was it. So
cool. Since
then, I've been buying other companies and growing them. So the one Fetching Millions was a totally different company. It's one I bought in Vegas. That one, we bought it for $0 and we owned it for 16 months. We fixed it as quick as we could, and we sold it to Service Champions out of Southern California. They're a great operation. They recently sold to Blackstone, but they were the ones that bought it. And they bought it for, I'm not allowed to say the number, but it was more than $50 million. So buy it for $0, own it for 16 months, sold it for over 50 million. And that was a really big win. Been trying to grow my other company since.
That's actually a great number and really a huge win, I would say. And how did you feel about that? I mean, that's a short term and such a great deal.
It was life-changing. I mean, that was the first one, because I've been buying companies up until then. It's the first time I got a big payout. I have stock in ServiceTitan. ServiceTitan's gone public now, and that kind of thing. So that's been great too. I had other companies that I've been buying, and now since then, other things have really, taken off. I had some shares in A1 Garage Door when Tommy Mello sold it, and he got a monster number. He's a heck of an operator. I was so glad to be able to be with him for a little bit on that ride. And that was really life-changing. Anyway, there's just a lot of big things have taken off, and it really changed my mind about things. So
Cool.
Since then, I've really spent a lot of time, thinking about what I was going to do. And like I said, that was the one I wrote the book about. It's an easy read, by the way. It's on Amazon if you want it, or audiobook or whatever, called Fetching Millions. And the company's called Fetch A Tech. In that one, though, I noticed some issues that we had. We had one really critical sales guy. His name was Brent Buckley. And a lot of people know who Brent is. And he was an amazing salesperson. And he sold 14 million for that year in sales and the total we did in revenue was 25 million that year. So when you have one person that does more than half of your revenue, it's kind of scary for any buyer. And so since then, I've realized I don't want to have companies like that anymore, where I'm so reliant on one person. At Lee's, which is my biggest company now, and that's the one that I bought, by the way, that the owner let me carry the note on.
So the first one.
Yeah, it was the first one in the industry that I owned. I've been building it ever since, and it's huge now. It was literally 1.6 million in revenue when I got it. And now this year we'll do 150. But looking back on that, it was really hard. You're trying to get through it. I'm grinding. When I first got it, I was literally driving a tractor in the middle of the night for $10 an hour, just trying to, make some money to feed my family while my, company was struggling to survive. As I've gotten there now, I realized I don't want to be reliant on one person like I was at Fetch A Tech. But to fix the company, I brought in a sales guy that really could kill it. His name's Phil Fulaski. Phil ended up doing $19.6 million in revenue in 1 year.
Amazing.
And that's in person. That's not over the phone. He literally, so if you think about it, he had a $26,000 average ticket. So he had to go to 3 houses. He had to sell 3 jobs a day at $26,000 each, 5 days a week, all year to hit that number. The reality is he actually worked 7 days a week, and he'd run 4 calls, sometimes 5. So he'd sell 2 or 3. His close rate was sitting around 64%, if I remember right, 65, 66. He was hovering around there. And granted, we gave him a lot of calls, but for the first couple months, he was literally running tune-ups, and he was selling brand new systems on tune-ups over and over and over again, which was amazing to me. He's just such an incredible salesperson. Now, we don't have him run tune-ups anymore, but he gets flip leads from techs that are flipping old systems. But anyway, so he did really well, but I realized I don't want that one person. I don't want to be relying on one person. I talked to Phil about it. I said, look, Phil, you got to be really careful. If something happens to you, whatever, you're in trouble, because, you get hit by a bus, you get a broken leg, whatever, you can't work. We need to find something. He agreed. He's like, he didn't want to be crawling around in attics for the rest of his life either. So he built a whole sales training program on how he does his sales. Wow. It was also because everyone and their brother was calling me saying, hey, can I come do a ride along with Phil? Can I have my people go ride along with Phil and see what he does? And they did for a while. And Phil called me and said, I don't want any more ride-alongs, man. I just need to focus on leads and make sure it's growing. And I said, okay, that's Lee's, my big company. And he said, we're getting ready for sale. I don't want to be doing these ride-alongs. So we decided we could kill 2 birds with one stone by building a training program that really trained all of our staff inside Lee's to make them successful. Now we have several people inside our company now that do 5 million in sales or higher each. Instead of having Phil do 19 million in sales, we have a bunch of people that do $5 million in sales. And I told him, I said, it's okay if you don't replicate yourself, just make them good enough. I mean, a $5 million a year salesperson right now in HVAC is great. I'm like, that's fine. I want a bunch of them. And so we built the whole training program with his training process, which is really surprising how he does it. And I was shocked, really, when I did a ride along with him. I couldn't believe how simple it was. And I said, okay, so we put this in this training program, and then we gave it to all of our people. And then I went through and I filmed a whole training program on marketing and operations and HR and accounting and everything else. And I trained those myself. And we put it into a learning management system. And it basically, we could give it to our people and they can go on and watch the videos and take tests. After each video, it asks them questions to make sure they're retaining the information. It gives them certificates and badges to say, hey, they completed this. We decided to make it into a company. So we made a company called Real American Grit. And if you go to realamericangrit.com or realamericangrit.com/offer, you can buy it. And it's about like $600 to $1,000 to $1,500 for your company, depending on what you want. And we even made it so that you can add your own training videos on there too, that you have for your onboarding or whatever. And people can learn our process, how we did it, how we scaled. It's got, right now it has 245 training videos on it. And so
That's amazing.
training on how to build your company and how to grow it. There's ones on how to acquire your competitors and how to buy them and how to value them and that kind of stuff.
Actually, that was my question about like how you train your people, but you already answered it. And at which stage of the company development you implemented this kind of structured training and system of training?
So I always tried a sales training, and the sales training is really hard that I could never get right. And that was early on. We tried. I always started giving training early on in the company. And if you're not a very big company, at the time, there wasn't a good one. There used to be DVDs and things you could put in and have people watch it. So I had to do the training a lot myself. I didn't want them sitting around watching a DVD. It's just, they don't retain anything. You know, if there's no tests, there's no interactivity. With our Real American Grit thing, we even made an AI customer. And so they can role play with the customer and it grades them against whether or not they're following Phil's training. So I didn't have that early on, but I would stand in front of the team and do our trainings every day. I did trainings on lean management, which trained our whole staff. I sent people to universities. I made a rule in my company that if you wanted to go to college, it was paid for by Lee's. As long as you got a C or better, you got reimbursed. So I've sent people now to Harvard, Stanford, 3 or 4 people to Stanford now. One to UCLA. I've sent people to Fresno State. I've sent a bunch of people to the local community college in Fresno where the company was. And we really wanted the team to be really strong, really smart, know what they were doing when it came to the trades, when it came to finance, when it came to sales, whatever. But now we're able to put it into a whole interactive learning management system that tracks your team and makes sure that they're all learning properly and that kind of stuff. And that's what Real American Grit is.
So it's already live and everybody can join the program, right? And as you said, okay, cool.
We just launched it literally a week ago. Because before that was just for my company. I made it, I was like, I'm going to build this and I'm going to have my team do it so that I can sell my company. I don't want to have a company. Phil has literally only sold 2 jobs this year. And it's now June 9th when we're recording this podcast. So
his task right now is to train them and build this training system. Okay, got it. If we go back a little bit, when you were in the beginning, like scaling and building the company which you just acquired, I mean the first one, the Lee's, what did you face actually at that time? And what do you think out of your expertise and your experience with buying and selling and flipping the other businesses, what is the main thing which holds the company from growth and what holds the owners? I don't know, what's the problem there on 2, 3, 5 million in revenue when they're stuck there?
Yeah, I was going to say at every income level, there's a different something else holding them from growth. I think that 2 to 5 million is people being afraid to invest. They're afraid to invest in marketing. Typically, they're afraid to invest in their people, in training. They're afraid to invest in, hiring people. They're afraid to invest in trucks. They're afraid to invest. What I typically help them with getting through that is, I know this is going to sound weird, but it's budgeting. So when you're building a budget, your budget should forecast how much revenue you're going to do every month, how much cost of sale you're going to have for that. So in other words, for those of you that don't know what cost of sale is on this, that are listening to this, it's your materials, your labor, your commissions, anything you would pay for on a job only if you sold the job. Your marketing and your customer service reps and those kind of things are not cost of sale because those are things you have to pay for no matter what. Anyway, so your budget should show like what your revenue is going to be, what your cost of sale is going to be, and then your revenue minus cost of sale is gross profit. So it should show what your gross profit is going to be every month. And then below that, you have all your overhead expense. Now, those are the expenses they have to pay no matter what. Your insurance, your customer service reps, your management, that kind of thing. Then the bottom line is, so you take gross margin minus overhead is net profit. If we forecast that out and we get really comfortable with it and we understand what those costs are, it helps people be less afraid to invest the time and the money in either the people that they need or the advertising they need, because on that budget, it should really say like, this is how much you should spend in marketing to get there. And then you can check and say, okay, well, what percentage of revenue is my marketing? What's my customer acquisition cost? How many customers do I need to acquire this year? So when I'm talking about budgets and doing budget training, which some of that is in realamericangrit.com right now, but some of it I just do a live in-person training on like how to build your budget before you leave. That's something that I want them to go through and say, okay, what percentage of revenue comes in and that's from existing customers and what's from new customers. So that tells me how many new customers I have to acquire this year. Then I have to think about, okay, if I'm going to get that many new customers, how much do I have to pay to get them? If my customer acquisition costs, which I talk about in the training, but you figure out how much it costs you to acquire a new customer.
Mhm.
You should figure out that, okay, if I need to acquire 1,000 customers and it costs me $100 to acquire a customer, I should spend $100,000 in marketing. I think people have unrealistic ideas of their growth rates, and they think that they can just spend nothing on marketing. They think they can spend nothing on staff and then somehow grow to $10 million of revenue. It doesn't
Yeah.
happen that way. You need to have a
Right.
plan. That plan is your budget.
So the core is the budget, which you just described, right?
Yeah.
And this is what, like from your experience, this is what they actually missing on these levels, or some of them they have.
Usually fear is what they have at those levels. Because by the way, once you get past 5 million, you usually have to hire a intermediary manager, like service manager, install manager, something like that. You usually have a service manager before you hit that number. And then after that, you might have to get a general manager, someone that's like an operations person. A lot of times they're afraid to do that. And the way that I help them get over that is by building the budget and building the plan so that they can understand, okay, if I hire this person, this is how I get through it. Typically also I see people, they're building a budget, but they're not really building a budget. They're just building a wish, right? Like, oh, I wish I was 10 million in revenue. If I was 10 million in revenue, I would do $1 million in profit. Okay. That's not a budget. That's, if your budget breaks down and says, okay, if I'm at 10 million in revenue, I'm going to have this many CSRs. I'm going to have to do this much revenue per month. I'm going to have this many technicians. I'm going to have this many trucks. This is how much I'm going to have to spend in marketing. This is how much I plan to spend per customer to acquire each customer. This is how many phone calls I need to have. This is how many CSRs I have to answer those phone calls. This is what my call booking rate has to be. And then once I get my call booking rate, then when they run the call, this is what my conversion rate has to be. And this is what my average ticket has to be so that I can generate the money that I need to hit my budget. And so all those things should be taken into account. When I do my budget training, it's literally a 2-page document in Microsoft Excel. It's not that complicated, but all of the important things are covered so that you come out of it thinking, I got this. I know what I have to do per month. And then you need to make sure that your whole team is aware of it and participates in it. And then every week you need to go over that budget with your team saying, okay, where are we on track? I can't tell you, a lot of people at 3 to 4 or 5 million in budget and in revenue, I asked them what their budget is. They said, oh, I'm not sure. It's on Sally's desk. She's the accountant. And then I go to Sally's desk and she's like, oh, I don't know. It's on my computer somewhere. Literally, it was a budget they built 4 months ago. No one ever looks at it. No one thinks about it. It doesn't matter. Literally every week at Lee's, we have flash financials. Now, I don't expect small companies to be able to do this. Small companies, 3 to 5 million in revenue, you're probably going to get your financials once a month, hopefully within 2 weeks of the close of the month. At Lee's, we have it broken down by week. And so we have semi-closed financials every week and then fully closed financials once a month. Every week we're looking at how close we are on pace for budget and if we're hitting our numbers or not. And so that way we know, okay, this is where we're going.
I actually totally agree with the budget. And let's talk about the benchmarks. What would you recommend to see as a target or to set up as a target for EBITDA, for net profit, for gross margin or gross or costs and then labor, like marketing in percentage from the budget?
Yeah, it's hard to say. I mean, marketing is the hard one. And I'll tell you why. Marketing as a percentage of revenue is okay to look at after you built the budget, but it's not okay to look at to make your budget. And I'll explain that in a minute. But if you're looking at gross margin and what percentage that should be, it depends on your trade heavily. So for instance, I'm pretty happy with my HVAC departments that are heavily based on install being at 45% gross margin. My plumbing company though, my plumbing division, honestly, 50-55%. It just depends on where you're at. It also depends if you're doing new construction, you're going to be a lot lower margins. And if you're doing commercial, the margins get very different and you're pushing more towards volume. So if you're residential though, air conditioning, 45 to 50% total with service and everything, plumbing, 55% gross margin, and then electrical, I'd say 60 for your gross margin. Now, when it comes to marketing, I had a friend that many people know in the industry. And I won't say what his name is because then it'll explain who the PE group was at the bottom. But the PE group bottom, and he had a 14% cost of marketing, and he had 100% growth rate for the year. He was going from like 50 million to 100 million in revenue.
Only with marketing, or also acquiring other companies? What was the main?
All marketing. All marketing. They got mad at him and said, man, you're at 14% cost of marketing. You should be 6% like everyone else in our portfolio. If you went from 14 to 6, that would save us 8 percentage points, and we could put that 8 percentage points to the bottom line, and then you'd be more profitable. He called me and said, what do I do? And he said, they don't really understand. I said, well, tell them it's okay you can do that. And he said, why would I do that? I would drop from like 100% growth rate down to like 15% growth rate. I said, well, tell him that. Tell him all your other companies are growing at 15 to 20% and they all spend 6% on marketing. If you want me to grow at 100%, then I have to go acquire new customers. They're going to have to spend 14% on marketing. That's why I don't like it when people say, well, what should I be spending as a percentage of revenue on marketing? It's like, dude, people used to talk about that all the time. The old best practices groups talk about that because they didn't really understand how business works. These best practices groups were treating contractors like they're stupid morons that only know how to go like, oh, 8% cost of marketing, okay, or 10%. It was really stupid. It drives me insane when I hear them say that. No other business looks at it that way when they're budgeting, at least in any other industry that knows what they're doing. They'll look at it at the end after the fact and say, okay, this is what we spent as a percentage of revenue. And they look at their growth rate. What they're looking at, what real companies look at is cost of customer acquisition. In every business, you spend money to acquire customers. Then that customer generates a certain amount of profit. And that customer has a lifetime value. So you think about how much it costs to acquire that customer and think about like any subscription service. Like I have a subscription service. I know it sounds weird. I have a subscription service that delivers charcoal to my house. It's natural charcoal. I love cooking meat. I love making brisket and ribs and everything else. Now that charcoal company spent some money on some advertising to acquire me. And they probably know roughly how much charcoal I'm going to buy from them before I no longer am a customer. And they call that a churn, right? So I leave their service. So they might spend $100 on marketing to get me, knowing that they're only going to make $30 in gross profit on my first bag of charcoal I get. But they know I'm going to buy charcoal every month for 3.5 years, let's say, is their average lifetime. Well, that's 36 months. It's 42 months times $30 in gross margin. So they're going to sell me 42 bags on average times $30 gross margin is $1,260. So that's why they know they can spend $100 to acquire me as a customer. I'm just making up numbers to get $1,260 of gross profit in the lifetime of the customer. And they're dialing that in. No problem. In air conditioning and plumbing and HVAC and the trades, we get treated like we're stupid and we should just go, I should spend 5%. I should spend 6%. I can't tell you how stupid that is. Anyway, I'm so frustrated about it. But anyway, if you look at like, okay, how much is it going to cost me to acquire a customer? People say, how do you do that? The way to figure that out is look at how many new customers you acquired last year. And if you want a simple calculation overall, this is oversimplified, but this is how to think about it. Say I spent, let's say $100,000 in marketing last year, and I'm going to divide that by, let's just say that I acquired 200 customers. That means I spent $500 per customer on marketing. Does that make sense?
Yeah.
Let me pause here for a second. When I started talking to HVAC owners, I realized that most of the real insights are not on YouTube yet. There are inside conversations like this, and this is why I'm documenting everything I can. If this kind of content is valuable to you, hit that like and subscribe. It tells YouTube to show you more of it. And we will keep going deeper while building our HVAC American dream together.
Let's continue. So it's just a simple formula for any HVAC contractor how to calculate it, right?
Yeah. Now you can look at it per marketing methods. So you can look and say, okay, well, I spent $20,000 on Google and I only acquired 40 customers, but I spent $30,000 on Yelp and I acquired 150 customers or whatever. You can look at them per campaign and see which one is giving you the lowest cost of customer acquisition or highest or whatever. Sometimes a high customer acquisition cost is okay because that one I sell them brand new systems and that's a higher average ticket than if I acquire a customer for a tune-up and I'm getting like $100, whatever. And so you want to think about those things. And then you look at it for the year and say, okay, if my growth rate is going to be really low, I don't need to acquire a whole lot of new customers. Maybe I only have to acquire if I'm going to do $5 million in revenue this year, and I did $4.5 million last year, I'm probably going to get some recurring revenue from the customers I already have. So I only need to acquire X amount of customers. So I need to assume that I have to spend Y amount of dollars to get them. And if I'm going to go from $4.5 million to $10 million in revenue, I'm going to have to acquire a lot of new customers and I'm going to have to spend a lot of money to get there. And so you make those decisions at the beginning of the year and make a plan. And that allows you, when you make the plan, you know what's going to happen. Now, for some of you, that might not make a whole lot of sense because you say, man, my cost of customer acquisition is like $800 a customer and I can't grow that much this year because I'll run out of money. Okay, cool. at least you know that. So you're making a plan. So then slow your growth rate down, bring your profitability up, and then grow slower. That's okay.
Yeah, makes sense. And I have a couple of questions in this direction. When do you think is the best time to plan the next year financially? Is it the end of this current year or the beginning of the next?
I start doing it in like October and November.
So October,
that we have
November.
all of December with an understanding of what we're gonna have to do in January and February and March. My lease has a fiscal year that ends October 31st. So we have to start planning, in August and September for the following year. And it helps us get on the right track.
Cool, got it. And in terms of budgeting the marketing, you budgeted on the numbers which you had previously, or from the budget which you have for this year, like for future budget, in terms of either to hit the growth or.
I look at our existing because I need to find out how many existing customers I have and that kind of stuff and what we're capable of doing that year. And then I look at the following year and I think about how much I'm willing to spend on gaining market share. And I think about how many people we're gonna have to hire. So I build a rough budget with my team. And at Lee's, my largest one, I don't even participate in the process anymore. They pretty much build it on their own. But we look at like, oh gosh, am I able to hire that many people? Because sometimes you build the first budget and it says, oh my gosh, I'm not going to be able to hire that many people, or I'm not going to be able to get that many trucks, or I'm not going to be able to spend that much money on marketing, whatever. Okay, let's go back and redo the budget. So you kind of build it 2 or 3 times until you get to numbers that you're comfortable with. So at Lee's, my largest company, the CEO builds the budget with his team and everybody else. And then the CEO brings it to me and says, hey, I need to get this budget approved. And then I look at it. And sometimes after that, we massage it a little bit more and say, okay, well, are we okay with this? Where do we need to go? And then it's really important that the CEO of Lee's and I agree, and he feels comfortable with the number that he's able to hit. And I feel comfortable with the profitability that we get so that we're able to sell the company or whatever we're going to do. We're going to market literally in a month or so. Mm-hmm. And, everybody's on the same page.
Yeah, got it. I have a question about the time frame. Like when you plan this budget and when you calculate all the numbers, 1 month, like month by month. And usually the installation, it takes time. Yeah, sometimes you get leads this month and then you do the job next month, or I don't know, in a couple of months. And what would be, from your point of view, the right way to calculate these numbers? Which method would you use? Like lead came in and the deal is made, and then or when it's installed, when it's.
Yeah, we look at, for budgeting purposes, I always go off of the GAAP revenue. So GAAP is generally accepted accounting principles, and the revenue that comes in is the revenue that's completed. So when the job's completed and it's billable, regardless of whether the check comes in or not, when the customer pays, whatever else, we're looking at how much revenue came in for the month based on how much we completed. Mm-hmm. And that's called using an accrual accounting method as opposed to a cash method. I talk about this at realamericangrit.com, the class, but we go through like what is accrual and what is cash and how are they different and that kind of things and way to look at them. I've been surprised. I mean, I've met people that are 10, 20, 30 million in revenue and still are using the cash method and don't even know what the accrual method is. So they're looking at their bank account, trying to see whether or not they made money. And that's a great way to destroy your business. It's really rudimentary and it's not a smart way to run any business, but I mean, there's a lot of people that do it.
Yeah. If you can share just a quick example, how bad is it to the business? So if they don't.
Let me give you an example. So let's just say that I sell a job this month, and let's say it's June 30th, and there's only 30 days in June, and there's 31 days in July, right? So 30 days, on day 30, I sell the job for, I don't know, $20,000. I take $1,000 deposit because it's California and I can't collect any more than $1,000 as a deposit. They sign the contract, give me $1,000. Then the next month, I purchase the equipment and I have laborers go out there. And so the next month in August, I have about, I don't know, let's just say $3,000 in costs for labor and fuel and maybe, I don't know, some subcontractor, like a crane operator. Let's say we're going to put it on the roof of the house. Mm-hmm. That happens a lot in Central California. Now, keep in mind, I purchased equipment that month, right?
Right.
So I received $1,000 in cash in June. I spent $3,000 in cash in July. The customer, let's just say, for instance, that I don't collect the money from the customer because it takes me a few days to get it installed. And then the permit didn't get done. And so the customer doesn't want to pay till the permit gets collected or whatever. So I don't get paid until August 1st.
Mm-hmm.
And so then I collect $19,000 in August on a $20,000 job. And then I don't have to pay my bill on the equipment. And the equipment costs me, let's just say it's this isn't realistic, but let's just say it's a $10,000 equipment charge for like an inverter system and, a pad and all this other stuff. And so I got to pay $10,000. And okay, well, on the cash method, which is what most people use. And this happens, it gets really bad when you're doing 100 jobs a month, right?
Right.
But this is one job. What would your revenue be on the cash method in June? It would have been $1,000. What would your cost be? 0, because you didn't do any jobs or anything else. So looks like 100% profit job for $1,000 in June. July, what happens? Well, I had $3,000 in costs. Well, I had no extra revenue. No money came in, right?
Yeah,
so my labor. So it's negative $3,000 for the month in profit.
Mm-hmm.
Then August comes. I make $19,000, 100% profit. Then September comes. I have a negative $10,000 net profit because I had to pay my supplier. And so every month it's profit at 100%, negative 100%, positive 100%. It's just all over the map. Now, if you have an accrual accounting method on that same scenario in June, you would have had 0 revenue because you didn't earn the money. That deposit they gave to you goes in cash in the bank account, but it doesn't show up as revenue. It goes on your balance sheet as unearned revenue because you haven't earned it yet. It's just sitting in your account. In fact, if they cancel it, you technically have to give them back that $1,000.
Right.
Then in July, you do all the work. And on the accrual method, you would look at, okay, I bought $10,000 worth of equipment that I don't have to pay yet, but that's going to go on my accounts payable. So that's still a cost for this month. I have $3,000 in costs for my labor and all that stuff. That goes on this month. But also I finished the job. So I get a $20,000 revenue this month, all in July. So what happens is with the accrual method is you take all of your costs and match them to all of your revenue. So in July, you would have had $20,000 in revenue and $13,000 in costs with a $7,000 net profit. The cash will work itself out later, but that tells you like how profitable that job was and how well you did that month with what you actually produced.
Right.
You can't be making judgments on your company about, based on what's in your bank account, because that's not about what you actually earned and what you did as a business.
And in this scenario, I like it, by the way. We try to do it also this way. The marketing cost, it also goes to July in this case, or where do you calculate it correctly?
No, so on that one, your marketing cost goes every month. So that's your overhead. So all of these costs on the accrual method, and marketing costs can be done the same way, but it's when the actual marketing is spent. So let's just say that you prepay on the cash method, you prepaid your marketing in May before the job even started. So you got marketing for a year and you said, they had some deal where you pay up front, and sometimes it's like 6 months out, or and sometimes you do with rent too. You prepay your rent for the year, right?
Right.
It would be, let's say it's $100,000 in marketing. Well, let's say it's $120,000 in marketing because that makes it easier to do the math. That's $10,000 a month, right? But you paid the whole $120,000 in April. You didn't actually get the marketing value in April. You get the marketing value every month.
Yep.
So the accrual accounting method would take that 120 grand and it would spread it out over the whole year and charge your business per month based on when the marketing actually was achieved. Same thing with prepaid rent. You can prepay your rent up front and get the cash out of the bank account. I wouldn't recommend it unless you're, on the cash method for taxes. You might do that at the end of the year, try to get the cash out of the bank account. But bottom line is that the value you have from paying rent is actually being able to be in the building for that month. So what happens is the accountants will automatically spread that out over the year. And so a lot of people, I recommend running your business on the accrual method. And if you're allowed to, as long as you're less than 25 million in revenue, pay your taxes on the cash method. If you have a QuickBooks, it's literally one button. You can click a button and it switches your whole thing from cash to accrual and then from accrual back to cash. And so we used to pay taxes on the cash method and we would have everything else. We'd run the business on accrual. Now, once you get past $25 million in annual revenue, the IRS says no more. You got to pay on the accrual method, which is fine. But when you're small, it makes a lot of sense. You get down to the end of the year, you've got some extra profit laying around. You call up your landlord and say, hey, can I prepay you for next year? And just spend all the cash. You call up your marketing companies. Hey, can I prepay you? Can I do this and that? And you get all the money out of the bank account because you don't want to pay taxes, which is totally legal and totally fine. By the way, don't take my word on anything on tax stuff. Talk to your CPA, talk to a licensed professional, but talk to them about that and say, hey, can I do this? And that's fine. Just don't run your company on the cash method. That makes no sense. Just switch it back to accrual so you can keep your financials coming.
Got it. Thank you for that. And what about the customer acquisition cost? You calculate with this method, the period for this metric would be 1 year, or because as I understand, if we take it monthly, it will be jumping again because of this.
Yeah, no, I mean, your
marketing
customer acquisition cost is just, it's a notification to you of how things are going.
Mm-hmm.
So the actual cost is your marketing spend, and
Yeah.
your customer acquisition cost definitely is going to go up and down per month, especially if you're in air conditioning, because in air conditioning you're going to get a lot more customers in the summer, and you want that evened out throughout the year though when you're building your budget.
Yeah, let's talk about this shoulder season. What ideas or what really working things you have for the guys who are struggling during the shoulder season, and how to survive and how to keep your company stable or more or less stable in that period?
First of all, I tell people this, I tell my companies all the time. Overhead is the poison of your business, and making profit in your company is not natural. So a lot of people don't realize, like, the reason that making profit in your company is not natural is because the natural inclination for everybody is to spend more money. Oh, I need to add this one person to my office. Oh, I need to add this extra feature or software I need to buy, or some shiny object, some, I don't know, gadget or gizmo. I got to buy this special tool that everyone has to have, and I'm going to finance it, and it's going to cost me every month. No one typically is sitting there thinking, how can I spend less money, especially your employees? You might as the business owner, but your employees, they're looking for new things that they can buy to, make their job easier, make things go easier. Everyone wants another accountant so that they have to do less work. If I was running an accounting department and no one really knew what I was doing, I could say, okay, I need 5 accountants and just hire them all, so I have to do less work. Like, that's natural. They're a human being. That's normal. What you as a business owner needs to do is make sure that overhead goes down. The overhead is what gets charged to you every month, regardless of whether or not you do any revenue. So when the shoulder season comes, if your overhead's high, it kills you. So the point is like, you've got to go around and cut a lot of these overhead expenses that don't make any sense. I mean, I can tell you at a couple of my companies, we implemented AI phone answering services, and they hired more CSRs to answer the phones. I'm like, guys, why are we paying for AI phone answering, which, by the way, has been super successful? We're on ServiceTitan's voice agents right now, and it's just like killing it. Our call booking rate's really high, at over 80% with the virtual agents, and our bounce rate is 40%. Yeah. Cool. Bounce rate is like what happens, like what percentage of the time they say, hey, I want to talk to a human. It used to be 70% with our former service. I think that's what people aren't looking at right now, is everyone's so focused on call booking rate that they don't think about bounce rate. Bounce rate's the big thing with AI right now. It's like, how often do they want to talk to a human? We're down to 40%. So 60% of the calls can be answered by AI and completely handled. We shouldn't be hiring more people to answer the phones, but we are in some of my companies. And I'm going, guys, this is stupid. And so, because the natural thing is for people to want to hire more people, and no one wants to fire their friend, and no one wants to fire, their cousin or whatever else is in their company, you need to grow up, be a leader, and fire the people that have to be fired. That's it. Or lay them off or whatever. Second thing is, going to the shoulder season, is you should be cutting all your marketing during your busy season and slowing it down. Everyone seems to want to be booked out a month or so in the summer. It's not a badge of honor. You shouldn't. You should be slowing it down so that you can spend those marketing dollars in the off season when you need to. This is mission critical. The next thing is,
most of them, they do it differently. I mean, most of the contractors which I see, summertime, they just pour money into the marketing and then slow down it in the shoulder season.
It's cheaper to get new customers in the summer. If you have the capacity, fine. But typically, you don't even have the capacity in your busy season. Typically, already booked anyway. Why are you spending money on marketing? It just makes no sense. Save your marketing. It's kind of like storing bullets in your gun. You need to make sure that you have enough ammunition that you can go fight later. You don't need to fight in July when it's 110 degrees Fahrenheit outside. You're going to have to fight pretty hard when it's 75 in October. So, save your ammunition. Save your bullets. And fire them when you need them. The other thing is making sure that you're doing everything you can to get into new changing times with marketing. Like right now, social media is growing up a lot. A lot of this digital advertising retargeting is getting really, really good. You can even do TV retargeting now. YouTube is becoming a good marketing platform. There's a lot of stuff that for contractors, historically, social media, YouTube, a lot of these things have not been great. It's pretty much Google PPC, Google local service ads, and Yelp. And now other campaigns are coming into place that you got to make sure that you're doing all of them. Our number one return on investment for the longest time was tune-up mailers. And so even direct mail. Yeah, which is crazy. But we've gotten tune-up mailers to work really well for us, like a $49, $89 tune-up or something like that, just to get in the door, and then train your salespeople really well to upsell while they're in the home. Don't just stick to your old ways of like $500 off a new system. It's not going to work. It's not.
So you do your sales mostly through the tune-up offer, right?
Yeah. A lot of those, well, in the off season, a lot of tune-up postcards. We probably spend $10,000 to $15,000, $20,000 a month, on tune-up postcards, depending on the month.
Yeah. Which service do you use, if it's not a secret?
Oh, no, I don't have any secrets. I tell everyone everything. I think I'm like, even my competitors, they come and do shop tours at my shop. We have the whole day, and all the contractors come in for one day, and we go through every single position, like the CSR manager, the dispatch manager, the sales manager, whatever, and trains on how they do their position and what they do, and they answer questions. But no, in the past, we've used stochastic marketing. Mike Layton, it's stochastic. It's STOCHASTIC, and stochastic marketing they're out of St. Louis, and they did a lot of our direct mail campaigns for us.
Thank you for sharing. Yeah, I have a bunch of other questions, but maybe we can leave it for next meeting. Maybe we can meet offline or another online meeting if you have time. What would be the better?
Yeah. Have us do another one. Ask your listeners if they want me to come back. But I talk about all this stuff on realamericangrit.com. You can go on there and sign up if you want. You get the whole class and all the interactive stuff and the role play with Phil, and make sure you can hone your sales skills and that kind of stuff.
Yeah, that's amazing. I will put all the links to your websites and everything. I will put in the description below, so everybody can follow your social media and also this LLM learning system. So thank you for sharing. Thank you for being here. Yeah, I hope next time I would love to speak to you and to discuss this buying and selling companies, actually from the buyer's perspective. Yeah, how you choose, how you negotiate the buying process, and also from the selling perspective. If you want to sell, if you want to build business to sell, that also would be great to hear, like, your experience and your thoughts on that.
All right, awesome. Let's do it. Let's schedule another podcast. Just text me.
Okay, I'll text you.
Thank you.
Thank you, Tom. See you next time. Bye.
Thanks for watching. This channel is about real HVAC business, real numbers, and the journey of building the HVAC American dream. If you're on that path too, hit that like and subscribe button. And let me know in the comments below where you're at right now. So let's chat in the comments, and I'll see you in the next episode.